Welcome to lesson number 8 of our Market Profile Beyond the Basics course. We will review the disclaimer together as usual. Trading and investing involve high levels of risk. Future results can be dramatically different from the opinions expressed in this course. Past performance does not guarantee future performance. The presenter may or may not hold positions in the instruments discussed. In Lesson 8, we are going to continue our presentation on initial balance trading. The concept of the initial balance is an important one, as we've demonstrated in the previous lesson, and there's really quite a bit to it, and this is why I want to show you some more strategies using the initial balance, and to help you gain an appreciation for the extent of importance of the initial balance levels and initial balance trading systems. In our last lesson, I mentioned that we would operationalize the initial balance on our charts, and so with this lesson, you will be getting a chart definition. The chart definition you can build on your own. It's really quite simple, but I won't spend a lot of time going over how the chart is built, since I'm going to give you the chart definition. But suffice to say, we use the multiple periodicity indicator to build these initial balance levels. It makes it much easier for us. They are drawn in real time, live, as the market progresses. Once the initial balance high and the initial balance low are in place, automatically you'll have the 150% and the 200% initial balance levels shown on the chart. In this case, the slide before us really has IB levels for consecutive day sessions, and let me talk a little bit about that. First, make the distinction between the day and the evening sessions, since you can also have an IB level for an evening session. We are going to focus our discussion in this session on the day sessions rather than the evening sessions. So the initial balance, as we've defined it, and as we will continue to define it for the purposes of this session, is the first hour of trading during the US day session. Nevertheless, to be able to get a comprehensive view of the market, there is a button on the chart. It is on the lower left corner, and certainly you will have this button on the chart definition that you will get. By clicking on this button, you will have the option to switch back and forth between a day session or a Globex session. Naturally, the Globex session is the 24-hour session. But to get an image, or a chart, just like the one that I have open right now, if you will take a look at the bottom, Monday, Tuesday, Wednesday, Thursday. So I have 4 consecutive days in March: March 24th, March 25th, March 26th, March 27th, and each of those are full day sessions. If you notice, I don't have any evening trading on this chart at all, and that's why these are the actual day sessions. But naturally, if you want to look at the 24-hour period, you can use this toggle button to pull up the Globex for you. Quickly, to identify the different elements on the chart, it is a 30-minute chart, and it is for the ES Mini. And the reason I like to use ES Mini charts, even though these concepts can be applied to pretty much any instrument that's traded on an electronic index and gives us the data that we need, I like to use the ES Mini for the simple reason that it is a volatile instrument. It has a lot of mobility, and so it's easy for us to look at different price moves and be able to give good examples of the concepts and how they work in the marketplace. Some other instruments are not are much thinly are not as volatile. They're thinly traded, don't have the liquidity, and so they're not as easy to illustrate for us the concepts that we want to cover. But that's not to say that the concepts do not work on other instruments. All right, so let's go through a quick review here of the key elements on the chart, and let me highlight the IB high, and I've chosen the color cyan for my actual initial balance high and the initial balance low. So these two levels make up the first hour of trading. Each of these is a 30-minute candle. So this was my initial balance low, there's my initial balance high, and once you take this chart definition and open it, certainly you can use it in Market Delta or Investor RT. It'll work on either platform. You will automatically have the same exact chart. And you will see the power of this chart as we go through our presentation today. Simply just looking at the initial balance and tracking price movement with nothing else, how powerful a tool that will be, and how we will be able to identify different opportunities in the market. Now, the next level is the dark blue. So the cyan was my initial balance high, initial balance low. The dark blue is 150% initial balance low, so that is 50% plus my initial balance low, so it makes it 150%. And the one above it is 50% above the initial balance high. You can, once you have the chart definitions, go in and change those colors. You can make them different colors. You can change the thickness of each of these lines. It's entirely up to you, and you have the flexibility to do that. Now, if we continue on here, we will see that the third line above here is the 200%. Initial balance high, and similarly at the bottom we have the 200% initial balance low. On the left side of the chart next to the scale, you will actually have them labeled, and they'll tell you. You can see IBH 150 here, IBH 200, IBL and IBH, initial balance low, initial balance high, and again the 150 and the 200. So should you ever forget, if you look to the right side next to the scale, it'll identify for you exactly what that line represents. And it's the same thing for each of the days. So naturally, this is a 200%, this is a 200%, 200%. Now they vary and fluctuate because it all depends on what the actual initial balance is. If we get a wide initial balance, of course, the 200% level, a wide initial balance like we did here, the initial balance 200 will be quite a bit higher than if we were to get a narrow initial balance like we did on this day. Notice how close the 200% is to the actual initial balance. So the extent or the range of the initial balance naturally will influence where the 200 and the 150 are going to be. Now, let's get into how we use the initial balance on our 30-minute chart to trade. And one of the best things to do is to look at an example and take a look at how we can apply the concept. So we know that once the initial balance forms, prices are either going to move higher than the initial balance, they're going to move below the initial balance, or of course the third scenario, they're going to stay within initial balance. In this case here, we have two 30-minute candles consecutive, and they push the initial balance low. You can see it. Some people, as a general rule, which I don't like, by the way, this isn't one of the strategies that I like to use. The minute the initial balance starts to drop lower, they take a short, and they stay in it, I guess, until the prices stop dropping. I find that that's a rather random strategy, not a smart move. Simply because the initial balance range is expanding lower does not mean that the move will continue to drop or that there is a significant opportunity here. I prefer techniques that you will see now that use more of a structured analysis of what's going on in the market and what's happening in price. So let's actually take a closer look at what's happening here during the initial balance period. And we can only do that by, first of all, focusing on the initial balance high, initial balance low, these first two periods, and taking a look at where they are relative to the overall price action in the market. And the best way really is to sort of focus on them and take a look at what happened during this day, which happens to be a Monday. And we are going to compare what happened on Monday relative to what happened in the market on Friday, the prior day. So we will note that on Friday, okay, this is the week before, here's what happened. The market ended up closing below the 200% IB. And you can see right here, here's where we closed, right there. We have a green dotted line above it, a red line below it. And we know that this is where we closed. That's fact. And notice here's my IB 200% line. We closed below it. Naturally, that is a very bearish close. We closed below the 200% IB of the Friday day trading session. So the question then becomes, will we continue lower, or will we return back towards value? And of course you see in front of you what happened. It looks like prices did continue lower, but let's take a look at the actual price development of how things actually progressed in the market. Well, when we closed below the 200%, and that was a very bearish close, we come to find on Monday morning we open higher. So the first 30 minutes, prices open gapping up. Take a look at how much of a gap there is on the chart. A rather significant gap, if you will. And even though we had a bearish close, we end up opening higher, and we get a higher open on Monday. And so once you begin to analyze in the context, things start to look significantly different. All right, so what happens when we gap up? Well, we gapped up and we continued. So here was our open, and we continued higher. But in moving higher during this initial period, we weren't able to even make it up to the 150% level. So price begins to show weakness on the open. We open higher with a gap up. We try to keep going higher, but take a look at what happens. Our initial balance high is established up here, and it looks like it is right in between the midpoint between my initial balance low and my 150% initial balance low. So we couldn't make it quite to the initial balance low of the prior day session. So what happens then? When I begin to see prices coming back down, and they didn't have really much momentum or much force to continue to the upside, and as they break the high of this particular candle, which we had taken out in the gap, I would be thinking about a short. This would be a very nice short right at this level here that you see here. And so now at the open, as I notice the weakness, we've gone higher, come back down. As I take out and I begin to trade below the high of this candle, I would think this would be an important or a decent short level for me. Now I don't know how much or to what extent it'll continue dropping, but certainly as an initial target, this would be one of my targets, the 200% from the prior day, and then my next target really would be the close of the week. I'm seeing weakness, so we're going to drop. We're going to test the 200% from the prior day, and then subsequent to that, we are certainly going to look at testing the close of the prior week. Now, let's continue on and see what happens. Well, we not only meet our first target, we also continue lower, and we get down to the close, and notice what happens. We see a little bit of pushback. That should not cause you great alarm. Prices never move in a linear fashion in the market, so don't expect to see prices dropping immediately down like that. Prices tend to do this, up and down, up and down, up and down, and so on. So really, this is the best stop loss at this point. If I'm entering a short on Monday morning, my stop loss would be the initial balance high that's been established. If that gets taken out, then I would be out of that trade. Certainly, if I begin to see this and I'm alarmed, it is reasonable to exit your position, capture your profits, and wait for the next entry point. And if that's the case and we're going to continue lower, when would I know that the weakness continues? I would know that if, in fact, we take out the low of this doji that closed the prior week. So if we take out this low, which we did, I could then come back in as a short into the market because I see price has shown weakness and the weakness continues in the marketplace. So I'm using my initial balance lines to gauge the momentum in the market and the strength and the weakness of the directional movement that's taking place. So we take out the low here and we continue lower. Now we begin to finish the second hour, and I have two very bearish candles before me. At this point, if I'm still in the same trade or if I have a short trade on, at this point I would move my stop from the top here and I would put it at the open of this particular candle to better risk to do better risk management. Now let's see what happens as price action develops. Price actually shows further weakness as price drops below the IB low. So remember, we got the first two candles here. We established our initial balance for the day. Now, what happens next? I see more weakness as price drops lower than the initial balance low. Now, as prices continue to drop, remember, this level has been established. Once these are in place for the first hour, we know exactly where this is in terms of the 150%, and I know exactly where the 200% is, and they become targets for me. So if this weakness continues, I would anticipate my next target to be right here at the 200%, the 150% IB low level. And sure enough, price continues and drops. It touches it, and just a word of caution or a word of advice based on experience, quite often as prices come close to your target, you may want to exit a tick or two above the actual price target because the market sometimes will hit the target very, very quickly. Many buyers will be there waiting for it, and so it won't spend much time and you will not get a fill. So you want to be a tick or two above the actual target. The price will have been established for you. You will know it in advance. You you will know it the minute you enter right up here, because once the 1 hour has been finished, these levels have been established for the day session. And so you would exit your trade at that point, and that is a reasonable exit. Now, you might also think, well, perhaps prices would have navigated even lower. How do we know that they are not going to go? And we don't. And so what I would do, though, is once I meet a target, I do one of two things. Either I close my position, take my profit, and then wait to enter again if I get another indication that the move is going to continue in my direction, Or the other alternative, if you want to continue to stay in the trade, is to shave some of the profits from the trade and sort of maybe, depending on how many lots you trade, you might take off one or two and keep one going. There are a bunch of different strategies, but I tend to want to completely close my position and exit and go back in. Now, yes, I will not take the full move, and I won't get the maximum out of it, but for me, I feel that is usually a safer way, and I can pocket my profit as I go along rather than sort of continue to be exposed to potential market changes. So the IBs really helped us. We had we were able to gauge the strength of the price movement depending on the progression, and as the price continued to drop lower and take out some of the key levels in the market, it gave me opportunities to enter my trade. I certainly knew the direction, and it was very easy to identify the direction of where the market was going, basically by how prices are reacting to the different initial balance points. Now, price continues lower to the IB low here, and we asked the question, could price continue lower to the 200% IB low down here? Of course it could, but it is safer to capture our profits when we're up here. Because as you see, even though we did get a number of down candles here, at this point things did begin to change, and if you would have decided to stay in the trade at this point here, once this candle takes out the high of this candle, that would have been your exit. So you might as well have taken your profits back here a tick or two before we reached our 200% IB low. Now, not only were we able to capture a nice or several short entries in the market and to stay on the right side of the market using our IB levels, now we have a potential for a long entry, and we're able to see it because we see the price action relative to the IBs. And notice, all we have on our chart are just 30-minute candles and IB levels. Now take a look at what happens here to give us reason to enter here as a long entry. My 150% IB level looks like it has provided support. Notice I have several wicks beforehand. This is all sort of buying activity. Even though we close negative on each candle, none of them are able to close below the IB 150% level, the IB low 150%. Now notice what happens once we get this doji. We get a green 30-minute candle that takes out the high of this doji, and this would be the point when I would be willing to take a long entry. And of course, the next question I'm going to ask you is, if I were to do that, where is my target going to be? So our this actually should be our 150% IB low provided us the support. This is the 150%, not the 200. We never quite made it to the 200. And then we have a doji, and we take out the high of the doji, so we are ready to move higher. All right. Now, why would this be a good potential long entry for us? First of all, take a look at how the 150% IB low provides support for us. If you notice, the preceding 30-minute periods, all of them had wicks to the upside, and all of them ended up actually closing above the 150% IB low. Now, this last doji that has formed, take a look at what it tells us. First of all, it too closed above the IB low, and it tells us that this is a potential point of change. Now, once the following 30-minute period takes out the high of this doji, right here at this point right here, then that would be our entry as soon as that high is taken. And you will find that our risk management would be at a nice safe place right here at the low of the doji, since this was the lowest that prices had ever reached, and so that's a very safe stop loss. If we're going to break that low, we're probably going to drop even lower. However, if we don't break it, then we should expect to move higher. Now, established our risk management and our stop loss point, the next important question would be, where would our first target be? And naturally, my first target, I'm going to use my IB level again, and it would be the initial balance low. That would be a reasonable first target. Now, if I wanted a second target, it would actually be the point where the initial balance broke about halfway up here, and then as another reasonable target, the third target, I would look at the 150% up here, and that's right where we opened. If you notice, where we opened the day, so that would be another potential target if we were going to continue to move higher. But you have to keep in mind that at this point the day is really winding down. Take a look at when we take this entry. It's at about 10:30 in the morning, and when do we actually arrive at the initial balance low? We get there at about 11:30, around 12 o'clock, and then we tend to stall there for some time. Sometimes some individuals will choose to continue to carry a position into the next day. Others will prefer to exit. So perhaps once you reach your target one, you may choose to exit, especially when you begin to see that the market starts to consolidate around that level. And you will have plenty of opportunity to exit at that target level, and even at a tick or two better at that. So the initial target you will not have had any difficulty meeting if you're doing an intraday trade. And we identified that as the initial balance low for the day. Now, I'm going to go back to giving you sort of an idea about the overall price action and structure in the market, because we began by tackling the gap up, and I didn't show you a broader play in the market, or if you will, a broader context of what was going on. And I'm going to share with you this with you to make you aware of it, because it does happen frequently. These classic bear traps take place often in the market, and they squeeze a lot of people, especially smaller and inexperienced traders. So let's really take a look at sort of a behind the scenes look, if you will. Well, let's go back and take a look at what happened on the close of this particular day, which is Monday, when we close on Monday. We ended up with a bearish close in a downtrend, much in the same way that we did between Monday and Friday. Okay, we had something very, very similar. Take a look at what is happening here. We weren't able to pierce through the initial balance low, and we end up closing below it. So what happens when people see that? Well, they take a look and they notice that we are in fact in a downtrend, and it looks like here's another level of resistance. We were unable to pierce through it, and so this may lead many unseasoned traders or traders that are taking positions to think, well, perhaps I would like to take a short entry, and my expectation is prices are going to continue lower. Now we are going to look at how the initial balance levels help us to identify a classic bear trap. Now, let's take a look at the end of the day and see what was happening on Monday's session at the end of the session. We walked through what actually happened, and if we take a look at the ending of the day, we are actually closing below the initial balance low, which is a rather bearish close with two negative candles. And it looks like the initial balance low here, the initial balance low for the day, has formed a level of resistance. Now, you do see a little bit of what happened there, but notwithstanding, and we don't know what's going to happen, just from the look here, things are rather bearish. So what happens quite often is, since this is now perceived as a level of resistance, and we have in fact been in a downtrend, that's really the trend that's been going on in the past 2 days, some will choose to hold on to a short at this point, thinking that prices will continue lower. And the market does give the impression that we have met a level of resistance here, especially if you take a look at the initial balance, and the first two periods were both negative. So obviously this was all selling, and when we tried to come back into the seller's territory, it does not look like we've had a lot of success. So what happens is you will get a number of individuals, and maybe even some seasoned traders who like to hold on to swing positions, who may already have been in the trade from an earlier point back up here, continue to stay in the short, and they will perceive and they will see this as a bearish close for the Monday day session. Now, let's take a look together at what happens after this bearish close, or this classic bear trap, and I'll explain to you why it is such a big bear trap. Well, it is a bearish close in a downtrend, so it encourages some to get into the market with a short, and also price takes out the prior low of the candle. If you notice, we did drop lower than the low of this candle, another bearish shine, and we do end up closing below the IB low. There's my initial balance right here, and we ended up closing below it. All very bearish so far. So we got a lot of bears interested in a short, and now let's take a look at what happens. Well, we end up with a gap up the following day. Prices actually end up opening higher up here. Notice the gap up. Here's where we close. The next day we gap up. What happens when you get such a big gap up? We had about a that's a good almost a 10-point gap up. So what's going to happen to the shorts that remained in this trade? Either took it short here, or were actually short from earlier on and were holding on to a position, and they see a gap up like this. Well, they would like to get out of their shorts. Hopefully, if they have some profit in it, capture that profit. It sure looks like we are not going to drop any further. So what happens is they begin to cover. And what do the shorts do to cover? They have to buy. So the shorts buy to cover, and in the gap, to get out of their trades and to cover their shorts. Now, what's happening? Who actually is taking the other side of this trade? As they are buying, they're buying from the strong seller, and the strong seller that was present in the market gets to sell at a higher price, and they are probably the ones that sort of are responsible for this bear trap. It gives them an opportunity to sell at a better price. So they allowed prices to rise higher, and this usually happens in the evening session on fairly low volume. Prices come up here, but the seller is still alive and well up here, and we saw their impact on the market from the preceding drop the other day. But now these poor bears are trapped up here, okay, and they're panicking and they want to get out. If their stop was up here, then this certainly has exceeded the stop. We've taken out those stops, and it's time to exit that short trade. Notice what happens though in the market. As more and more sellers begin to cover, more and more sellers begin to sell to them, or that one huge strong seller starts to sell at a much higher price. And before you know it, since there really was not a strong buyer that's lifting prices higher and taking the market higher, take a look at what happens after this initial balance period, which is a rather small one here. But notice the 2 wicks on those two 30-minute periods. And here's where I had mentioned earlier, some people think I should always take the trade in the direction of the expansion of the range, of the initial balance range. And I told you that I did not recommend and I did not like that strategy. Notice we did expand to the upside, but to no avail, and we really didn't move all that much. Not only that, even with this gap up and with the entire first hour of trading, we did not even come back up for a test of the initial balance high. There wasn't enough strength in the buyers to be able to even make it up for a retest of the prior day's initial balance high. When you observe that and you understand the dynamics of what's going on in the market, you then realize that you have a high probability short entry on your hands. And as soon as the market begins to take prices lower than the second 30-minute period, you would probably feel that this would be a safe short entry. Now, the other point that I really want to highlight is, yes, we gapped up, but we gapped up into resistance. It's almost like there's this very powerful seller with their arms open waiting for buyers, and we jumped into their lap and they said, here, take all you want. We can give you all you want. And they inundated the buyers and they just overtook them. Take a look at the resistance zone, price zone up here, this area here, and what happened after that. Prices dropped. So obviously this is a zone of resistance, and we gapped right into it, right into that zone of resistance. Once you see that and you begin to see these patterns develop, and you begin to see that even the initial balance high of the prior day we weren't even able to test that during the first hour of trading, which is usually sort of has the greatest level of volatility, then that is a strong indication that the seller is still alive, well present, and strong in the marketplace. Now take a look at what actually happens. The seller did take prices lower. We continued with a reasonably small range for the day. We started out with a small initial balance, and whenever you see that this often happens, you end up with a fairly small range for the day. Look at where the 200% is, look at where the 150% is. Not really that far, but we dropped and we continued to drop lower and lower throughout, up to at least 9:30 in the morning. Prices were dropping. Now, there are two things that I want to draw your attention to. The first is, notice how prices are reacting when we've come back to visit the zone of the initial balance low of the prior day session. What does it look like we have going on here? Do we have buyers here at this level, or does it look like we have more sellers? And it should be evident that because we have some wicks to the upside and we have one green candle that has taken out the high of this candle, that we actually have some buying activity at this level. And the other point that I want to draw your attention to is, don't get excited when you see a gap up in the morning. A gap up is not an indication of extreme strength. It could be that it just happened that overnight on low volume prices were pushed higher. There were a small amount of buyers, and now they too want to exit their positions. And so if they manage to push the market higher and they want to exit, the seller is very happy to sell to them as they begin to exit, because they'll be selling their long positions. So there are a lot of dynamics that could be behind a gap up, and don't always assume that a gap up is a sign of extreme bullishness. And more importantly, be careful. Always look to the left. Are we gapping into resistance? And if we're gapping into resistance, then you should be cautious and realize that if we've not overcome the resistance, we're likely to go back to where we came from. In this instance here, as prices dropped, they dropped to a level. If we look to the left, the level indicates that we have some buyers, or at least some level of support here. When we take a look to the left, we will see that on the prior day prices did move a little bit higher, and we have somewhat of a potential support zone here. Now, supports and resistance do get broken, but we should at least be attentive and pay attention and see what is likely to happen. Now, notice what happens. We talked about the support here. Well, looks like it held. Now, did it push prices significantly higher? Well, we certainly managed to get above the 150% IB low, and we made it all the way to our actual IB low of the day. But we sort of have stalled and have continued to hover around there. Now, does that tell me that this support zone has a very strong, aggressive buyer that's willing to initiate, or perhaps it is a responsive buyer that feels this may be a good place to buy, but not really an initiator, someone that is pushing the market in one direction or another? And now I'm going to ask an interesting question, and that is, at this point, we are at the end of the day on Tuesday, and we're getting ready for the next day. Would you be willing to hold a long position overnight based on the chart pattern that you see there? Does this look like a bearish or bullish move that's going to happen? Well, there are a number of things on the chart that would certainly cause me or give me pause about staying in a long position. A number of things. First of all, we haven't yet seen any sign that we were able to take out these powerful sellers that are back up here. Yes, we have a buyer here, but this does not tell me, or at least for me, it doesn't give me a lot of confidence that after 1, 2, 3, 4, 5, 6, 7 periods, we were able to really penetrate much into their territory. And so my answer would be no, I would not be willing to hold a long position. And the next question would be, well, would I be willing to hold a short position? Well, overnight is always tricky. So why not, especially if I had made some gains during the day, capture those gains, exit, and wait to see what will actually happen on the following day. A very important part of any strategy is understanding the overall price action within the market. There's nothing here on the chart that tells me I am on, I'm going to spring up or spring down. So I think patience would be the best order of the day in terms of that formation and that pattern that we see at the end of the day right here. Now take a look at what happens. We get another price gap up. And I have just shared with you some valuable insights about gapping up into resistance and instructing you to look to the left. And hopefully now you are going to begin to apply the fruits of our lesson. Our initial balance low is right here. Our initial balance high is right there. We've got 30 minutes of trading under our belt. We've started a new day, new trading day. This is Wednesday. And now the question is, and we've gapped up, look, another significant gap up. Are prices going to continue to move higher, or are they going to move lower? And the first thing we want you to do is to begin to learn to look to the left. Have we overcome the sellers? Are we above our resistance zones? And I hope that the answer you are saying is absolutely not. When we take a look at what was happening at these levels, at these price levels, when prices were there last, we had very strong selling activity. And that's what you want to be looking at. Do I see anything here at the gap up after this 30-minute period that indicates I have strong buyers that have the wherewithal to push significantly higher and pierce through those sellers? And the answer is no. I don't have anything that really indicates a candle to the downside, a negative candle. That does not look bullish to me, and I have a bunch of strong sellers up here. So would I be willing to take a short immediately? Well, I'm always of the conservative school, and if you wanted to be an aggressive trader, I guess you could. That would be a reasonable trade to take, and you could make your stop, the initial balance, high. However, I will wait to see what happens during the next 30-minute period. And if you take a look at what happens, it actually drops, takes out the low. At this point, this is the point when I would be interested in a short, and I would take the short. And certainly my first target would be the initial balance low. Now notice what happens. We do drop down. We don't quite make it to the initial balance low, and we actually get a bullish candle that actually takes out the high of this level right here. Well, this is a bull trap. Just like there are bear traps, there is a bull trap. And in this case, you have these three, and then one up indicating we're going to move higher, and then it gets negated, and we create a sandwich, meaning we have one bullish candle between two negative ones. Now, the safe thing to do, if in fact you were in an entry and you had put your stop loss up here at the proper risk management position, you entered here, and this happened, you should be patient and you should wait. The analysis of the overall activity of the market is stronger than this bull trap. If in fact it ends up coming back up here, takes you out, it does happen. Trading does involve some losses. You should take your loss immediately, and not sort of continue to hope that things will get better. There are times when things like that do happen. But in this case, you are still in safe territory because the broader analysis indicated we have hit sellers in the market. We also, when we shot up, we did not manage to go very far beyond. We opened right above about here at the initial balance high of the prior day, and again we just made it 50% above it, and that's not a very strong open, and then we started dropping and extending the range lower. So if you would have stuck it out and held to your risk management parameters, your trade will have panned out, and certainly you would have met your first target, initial balance low here. You would have also met your second target, initial balance 150%. You also would eventually also met the 200%. This happened to be an incredibly strong negative day, and prices continued lower. Now, when I run out of my 200%, what am I looking at next? Well, I'm looking at this level next, then this level from the prior days, because they tend to hold, and this level. Now, notice what level actually held. It was the 200% from Monday, right about here. Notice the buyers. This is when the buyers stepped in. because that was the 200% IB level from Monday. These levels are important, and they do track from one day to the next. That's when they began to respond. Want you to keep in mind that all we've been looking at have been just initial balance levels and candles, price action and initial balance levels. You can actually trade on the basis of those two alone, and it goes to show you the power of these initial balances. We are now going to add another tool to our initial balances, and I will show you how that even helps us to further enhance our analysis and give us stronger indications in terms of direction and trade. I'm adding profiles to each of the days. So on this chart, each of the different days that you see has its day profile in addition to the initial balance levels. Having the profile on the chart certainly will show us some very interesting observations and will help to illustrate the power of the IB lines in tandem with profile analysis. Notice here on the very first profile, we have talked earlier about strong sellers, but it's quite visible here on the profile. Look at how there is really very little development as these two candles and the prices drop, indicating there wasn't really any resistance. No one was able to stand in the way of the sellers in this area, and it shows the strong selling activity that we alluded to earlier. Not only that, take a look here. When we open early in the day up here, we are significantly above the prior value area high. You can see that. Now, usually if we've deviated that much away from the value area high without a retest, the probability that we'll come back for a retest is quite high. And so at the open, as we take a look and see that the next 30-minute period tries to move higher and fails, and then comes back and closes below this period, I would be a comfortable seller. Notice it drops and comes right back to the value area high from the prior day. Now, we do see a little bit of support here, bounces back up, but then drops again, and then eventually when we see a close above it, that's when we're ready to move on to another level. So the value area high from this prior day continued to be an important level, and then when you see it in combination with the, in this case, the 200% IB from the next day, that adds even greater significance to that 200% IB level. And notice when we drop below it, we're really right back down here to the naked POC of the prior day, and it held, and then we started moving higher towards the new point of control for this day. And the same thing will happen on the following day. You will see that prices, as they jumped higher, will want to come back for a retest of the value area high, and if that test fails, they will come back for a retest of the naked or the volume point of control, and you notice what happened. Prices continued to drop in that case. Now, when we open above the prior value area high, the reason that we continued to drop and prices continued to fall was price was also unable to overtake the prior IB high. Notice we're not going to move any higher until we clear each of these key levels, and the IB high from this day is a key level, and we never even reached it. We couldn't clear it. Those are all early signs of weakness, price weakness, and they help increase our level of comfort with a short, should we choose to take a short early in the day. when you see that we haven't even cleared the prior initial balance high. For us to continue moving higher, we need to at least be able to close above the initial balance high of the prior day, and then we can comfortably continue to move onwards and upwards. Now, take a look here what happens when price drops down to the naked POC. Well, it looks like it has found support. Take a look at this wick up, the next wick up, and then this big green candle up above. Now we're getting into territory above the value area high from the prior day. This level used to be resistance on the prior day, but in this case we've cleared the initial balance low, and now we are about to clear the 200%, and we continue onwards towards the 150%. Our next target would be the initial balance low, and notice how it coincides with the point of control for the day. So as far as trading on this particular day, we were not really able to move much further beyond the initial balance low for the day. We continued to hover around it. If you look at how price reacts to prior value area lows and initial balance lows, this will help you in determining whether the trade you are about to take is a good one or not. So in this case, when we drop down here, we find that we have an initial balance low in tandem with a volume point of control. And look at how price reacted to that. It immediately found support. That's an important level. The two levels together begin to reinforce one another, and then we see a bounce off of that level, and prices tend to move a little bit higher. Now we know that we cleared one initial balance low, so now let's go back up to the next initial balance low, and let's see if we can in fact clear it and move above it. And that's what the market is constantly doing. It's going back and forth between these different levels and testing them. Now, I also want to point out to you, and I want you to observe how this price zone was overcome. This was a support zone. We knew that it was a support zone from over here when we looked to the left. Notice prices actually ended up moving higher, and we made it all the way to the naked POC up here. So when we came to this area, this was the value area high all the way back from this Monday, and we're right here, and this was a support zone. So the expectation was that it would be a continued support. And sure enough, look at the three wicks, 1, 2, 3, and a green candle. And certainly I would not have faulted anyone if they would have taken a long once we took out the high of this candle. But then look what happens. Prices turn back around, drop, and we continue dropping. Now, in a couple of moments, I will show you some things that will help us avoid this particular entry going long at this point. As good as it looks at a level of support, we have some other tools that help us to sort of avoid or reduce the number of traps that one might fall into. But this was a perfect setup for a long, in some ways, a support zone, only to see it fail in the next period. The important thing is to understand price action and then to begin to be aware of what the patterns look like when we're overcoming a zone, or when in fact we cannot overcome and we get a breakdown and start to move in the other direction. There are a number of things that I'll point out to you here why a long would not have been a prudent entry at this point, and that comes through experience and through sort of understanding the dynamics of the market, and also using a couple of additional tools on our charts, which we will talk about in just a couple of minutes. I just want to show the different areas where we had overlap between a profile parameter and an initial balance parameter. Here we have a value area high, and notice that is also an initial balance high, and notice how that formed a level of resistance up here. And you can count on the fact that this level will come back to be tested because prices were rejected at this level, at this IBH 150% of this prior day, and then at the actual initial balance high for this day. And we will not be able to move higher until, in fact, prices come back up here and are able to create support out of this level. Keep that in mind as you are analyzing and looking at your charts. Know the different points where the market has to overcome and has to sort of change the dynamics at these levels before it continues higher or before it continues moving lower. We had a couple of interesting bull traps, and I tried to highlight them for you in our discussions. Now the key question is, how do we avoid them? One of them was here at this area. We had 3 consecutive periods heading down, and then all of a sudden we get a green candle, and of course we don't see this, so we have to analyze in the context of what appears at the time that we see it. And then we get a higher high, and we in fact close significantly above the open of the prior candle. So it looks like we are in fact experiencing a reversal. This used to be an area of support, and so perhaps our support level now is up here, and it's time for us to continue to move higher. A lot of longs will be taken at this point, and now that creates a lot of bulls that, when we look at the after effect, that get trapped in the market. And as I mentioned, I'll show you and I'll talk to you in a moment about how to avoid some of these. Same thing here. Take a look. This was a support zone. This was perhaps even a trickier point. Support, 3 needles in a row. We take out the high, and then bam, we see a significant price drop. So the bulls got trapped twice here. And let's see how profile traders would have been able to avoid those 2 traps. First of all, let's see if the 30-minute 5 SMA rule would have helped us. In other words, it is not prudent to take any long trades until the 30-minute period closes above the simple 5. So in this case, the 30-minute did close above, but what happened here was we didn't get a higher high. So in this case, the 30-minute 5 SMA rule would have saved me from taking this long. But let's take a look here. Would it have worked here? Same thing again. If you notice here, the 30-minute period came right up to the 30 minutes but never closed above it. So what you want to do is you want a close above it, and then you want the prices to continue ascending higher. That is a much safer, much higher probability long than sort of just taking it as soon as it closes above the 5 simple moving average on the 30-minute chart. This is a very important rule. Keep it in mind. It will save you from a lot of bad trades. So this was one way to avoid those 2 bull traps. Here's another way that would have helped us also, the data, by looking at our footprint bar statistics, something that other traders would not have access to. Let's take a look at what we see happening here during this period. Yes, it's a big green candle, but the cumulative delta for the day is still negative. I also have a negative finish, so I have a divergence. I have a positive candle with a negative finish. That is not comforting for a long breakout. It does not really bode well for continuity. And sure enough, here's what happens. Prices continue to drop. Now, let's take a look at the data for the next bear trap on our chart here and see what happens there. Here, if we were to take a look at this particular candle and notice the data, first of all, the volume is significantly lower. Usually volume begins to increase if we're going to get a breakout in that direction. In this case, it didn't. And then look at the finish, again another negative finish, and the delta for the day is significantly high. It's negative 26,000. So there are a number of different ways that help us as profile traders with the data that we have and the tools that are available to us to protect us from taking some of these trades where others may get trapped. All right, with that, I'm going to conclude our lesson today on initial balance trading. And hopefully you've had some good examples here. I'd like you to begin applying them at the open. It is very helpful. And the best way to learn is really to put the knowledge in action. Again, feel free to forward your questions and answers, and it will be my pleasure to answer them. Good luck trading, and I'll see you in the next lesson.